Wall Street is buying what they're telling you to sell. And if you fall for it, April 2026 will be the month you look back on with regret for the next decade. Let me explain exactly what's happening. Right now, today, April 4th, 2026, every major financial outlet is running the same story. Markets are shaky. The S&P 500 dropped 3.1% over the last 9 trading sessions. The Nasdaq is down 4.7% since March 20th. CNBC says correction territory. Bloomberg says risk-off environment. Fox Business says investor caution warranted. They're all singing the same hymn: sell, reduce exposure, go to cash, wait it out. And that is exactly the mistake that is about to cost retail investors a fortune. Here's what they're not telling you. While the headlines scream fear, institutional money is doing the opposite. SEC 13F HR filings that updated on March 31st show something stunning. BlackRock increased its equity allocation by $18.6 billion in Q1. Vanguard's total stock market index saw net inflows of $12.3 billion in March alone. Citadel opened new long positions in 47 stocks across semiconductors and defense in the last 6 weeks. These aren't scared people. These are the people who make money when you panic. So why the disconnect? Why is the financial media telling you to run while the biggest players on earth are loading up? Because the real story isn't the pullback. The real story is what caused the pullback, and it's not what you think. On March 22nd, the Bank of Japan unexpectedly signaled it would hold rates at 0.35% through Q3 instead of the anticipated hike to 0.5%. That single announcement triggered a $2.1 trillion yen carry trade unwind over 8 days. Hedge funds borrowing cheap yen to buy American equities suddenly had to rebalance. That forced selling. Not panic, not fundamentals, plumbing, financial plumbing. The S&P didn't drop because American companies got worse. Apple still posted $127 billion in Q1 revenue. NVIDIA's data center backlog hit $94 billion. Microsoft Azure grew 31% year over year. The fundamentals didn't change. The flow of money changed temporarily. And that is a massive difference that most retail investors do not understand. Here's the money trail. Follow this carefully. When the yen carry trade unwinds, it creates forced selling in U.S. equities. Prices drop, retail investors see red, they sell, that pushes prices lower. And then institutional buyers, the BlackRocks, the Bridgewaters, the sovereign wealth funds, step in and buy at a discount. The Abu Dhabi Investment Authority allocated an additional $7.4 billion to U.S. equities in the last 2 weeks of March. Norway's government pension fund increased its American tech weighting by 1.8 percentage points. They are buying your shares at prices you're giving away because a headline made you nervous. Let me give you 4 data points that prove this is a trap. 1. The VIX spiked to 28.4 on April 1st. Every single time the VIX has crossed 27 in the last 15 years and then receded within 5 trading days, the S&P 500 was higher by an average of 14.2% 6 months later. Every single time. 2. Insider buying at S&P 500 companies hit a 19-month high in March. CEOs and CFOs are buying their own stock with their own money. They filed 1,247 Form 4 insider purchase disclosures. That's 340% above the 12-month average. They know something. 3. The Federal Reserve's next meeting is May 6th. Fed funds futures as of this morning are pricing in a 74% chance of a 25 basis point cut. If that happens, it'll be the first cut since September 2025. Rate cuts are rocket fuel for equities, and the market hasn't priced it in yet because everyone's distracted by the pullback. 4. U.S. corporate earnings for Q1 2026 start reporting April 14th. Analyst consensus estimates have been revised upward for 68% of S&P 500 companies. That's the highest pre-earnings upward revision rate since Q4 2021. Companies are about to beat expectations into the ground, and if you sold before that happens, you're going to watch the rally from the sidelines. So here's your signal, and I'm going to be direct. Semiconductors, specifically NVIDIA, TSMC, and Broadcom, are a buy at these levels. The AI infrastructure build-out is not slowing down. NVIDIA's next-gen Rubin architecture ships Q3 2026, and every hyperscaler has pre-ordered. TSMC's Arizona fab just came online and is already at 80% capacity. These stocks are 9 to 14% off their February highs. That's a gift. Defense. Lockheed Martin, RTX, and Palantir buy. NATO's new 3.2% GDP defense spending mandate passed on March 28th. That's $340 billion in new annual defense contracts flowing into American firms. Palantir's NATO contract alone is worth $1.8 billion over 4 years. What should you sell? Long-dated Treasury bonds. If the Fed cuts in May, the curve steepens and the long end gets crushed. TLT is a trap right now. Sell it or short it, and wait on commercial real estate REITs. The office vacancy rate in major metros is still 21.3%. That sector needs 2 more quarters of data before it's safe. Here's what this means for you personally. If you're sitting on a 401k or an IRA and you move to cash this week because the market felt scary, you are doing exactly what the largest financial institutions on the planet want you to do. You're providing liquidity at a discount. You're the exit for their old positions and the entry for their new ones. The next 72 hours matter. Earnings season starts in 10 days. A Fed cut is 5 weeks away. Institutional money is already positioned. The carry trade unwind is stabilizing. The yen has already retraced 60% of its move as of this morning. This pullback is not the beginning of a crash. It's the beginning of a transfer of wealth from people who react to headlines to people who read the filings. April 2026 is not the month to be cautious. It's the month to be precise. The biggest mistake you can make right now isn't buying the wrong stock. It's buying nothing at all while Wall Street loads the truck with your shares at a discount. If nobody else is saying this, we are. Subscribe, follow the money with us.